Listen to me very carefully. If you are still standing after last week, you are a survivor. If you are still holding your position after seeing a negative 37.6% range in a single session, congratulations, you have passed the test. We just witnessed an absolute bloodbath, a historic flush. But guess what? We are still here. And more importantly, the charts are telling us a story that the mainstream media is completely ignoring. Silver has stabilized. I am going to repeat that because the trolls in the comments are screaming that it's over. Silver has stabilized. We saw a bearish reversal that was designed, specifically engineered, to shake the weak hands out of this market. We saw a wipeout. But overnight, and into Monday's session, something changed. The freefall stopped. The panic selling dried up. And we found a flaw. In this video, we are going deep. I mean deeper than we've ever gone before. I am going to break down exactly why 7132 is the most important number in your life right now. I am going to show you why the 50-day moving average is acting like a concrete wall against the paper shorts. We are going to talk about the anchored VWAP from October, an institutional level that nobody else is talking about. And we're going to look at the upside, because if this stabilization holds, if we can close above the 20-day average, we aren't just looking at a recovery. We are looking at a slingshot move back to $88 and beyond. But you need to be careful. The danger isn't over. Resistance is heavy. The algorithms are watching. I'm going to show you the gold setups, the silver targets, and the exact levels you need to watch to survive the next 24 hours. Do not skip a second of this. This is your playbook for the week. Let's get into the charts. Let's start with the elephant in the room, the volatility. The note I'm looking at, the data coming straight from the trading desk, highlights a number that should make your stomach churn. The high to low range on Friday was negative 37.6%. Let that sink in. Nearly 40% of the value swung in a single trading period. That provides a massive, wide range for silver to trade within before it goes anywhere. When you have a move that violent, the market is like a bell that has been struck with a sledgehammer. It vibrates. It rings. It takes time to settle down. This wasn't natural price discovery. You don't get a 37% wipeout in a monetary metal because the supply and demand changed overnight. No mines closed, no vaults opened. This was a liquidation event. This was a margin call cascade. But here is the key takeaway from Monday. We tested the lower end of that weekly range and it held. That is the signal. The bears threw the kitchen sink at this market. They threw the dishwasher, the fridge, and the house at it. And the price bounced. That tells me that the physical buyers stepped in exactly where the paper hands capitulated. We are entering a phase of price discovery. That's a fancy term for a brutal battle between the buyers trying to reclaim the trend and the sellers trying to force a lower low. But right now, the stabilization is real. Now, let's get technical, because opinions don't pay the bills, data does. Silver completed a sharp bearish reversal last week. There is no sugarcoating that. A bearish weekly engulfing candle. For those of you new to technical analysis, an engulfing candle means the selling pressure completely swallowed up the buying pressure from the previous week. It confirmed that, temporarily, the sellers were in charge. This drop took us to a 3-week low of $73.31 initially. That was the first crack in the dam. This likely established a high for now in the price of silver. We have to be realistic. The momentum was broken. But, and this is a massive but, look at where the selling stopped. Support was seen at a key intermediate trend level, marked by the 50-day moving average. Why does the 50-day matter? Because that is the institutional trend line. The hedge funds, the algorithms, the trend-following systems, they all have buy orders sitting at the 50-day average. When the price hit that line, the algorithm switched from sell to buy. During Monday's session, downward pressure remained. They tried to push it lower. They managed to print a slightly new retracement low of 71.32. Write that number down, tattoo it on your arm, 71.32. That is your line in the sand. As long as 71.32 holds, the bull market is alive. If that breaks, we are in a different world. but it held. Silver is set to close the day S session above the 50-day average for the second day in a row. This is crucial. One close above support could be a fluke. Two closes. That is a confirmation. It confirms the 50-day line as a valid trend support boundary. The bears tried to break the trench line. They failed. The bulls are digging in. I want to point out something that 99% of analysts are missing. The report I'm analyzing points out a fascinating detail. It is interesting to note that the new low of 71.32 found support near an anchored volume-weighted average price, AVWAP, indicator from the October swing high. If you don't know what VWAP is, it stands for volume-weighted average price. It's not just about price, it's about volume. It tells you the average price that everyone has paid for their position since a specific date. By anchoring it to the October swing high, we can see the average pain point for the shorts and the longs since that major peak. The fact that we bounced exactly at this AVWAP is not a coincidence. Markets are not random, they are calculated. The big money, the guys trading hundreds of millions of dollars in paper contracts, they watch this line. They stepped in to defend it. This confluence of the 50-day moving average and the anchored VWAP creates a floor of concrete. It's not just a technical level, it's a psychological barrier. Breaking through that requires massive energy, and the sellers just ran out of ammo. Let's talk about the candle structure. The dip to a new daily low on Monday did something important. It eliminated the potential for a bearish inside day to set up. Usually, an inside day, where the price stays within the previous day's range, indicates indecision. But by dipping lower and then rejecting that low, the market made a decision. It decided that prices below $71.32 were too cheap. A daily close above the middle of Monday, S range shows buyers increasing their interest in the precious metal. Let's do the math. The middle of the range is $79.64. This is specific. If we close in the upper half of the daily range, above that $79.64 mark, along with the support at the 50-day average, along with the bounce off the VWAP, this suggests that at least a short-term bottom may have been established at $71.32. This is how bottoms are formed. Not with a bang, but with a rejection of lower prices. We went down, looked into the abyss, and the buyers said, no, not today. If silver can continue to trade above the 50-day average, signs of accumulation should be seen. You will see volume picking up on the green candles. You will see the dips being bought faster. This will be followed by higher prices to test prior support as resistance. We are transitioning from panic to accumulation. Now, I am not a moon boy. I am not here to tell you we are going to $1,000 tomorrow. I am here to manage risk. While the floor looks solid at $71, the ceiling is lowering. There is a confluence of several levels, pointing to possible resistance near the internal uptrend line and the 20-day moving average trend indicator at $92.95. Since the lines have converged, the 20-day average provides a more specific price to watch. The 20-day average is the short-term momentum indicator. It provided a lower boundary for the rising trend until it failed last Friday. Remember that. Last week, the 20-day was support. Now, it is resistance. That is the golden rule of technical analysis. Broken support becomes new resistance. The price is currently trapped. It is trapped between the 50-day average, support at 71, and the 20-day average, resistance at 92.95. This is the kill zone. This is where the choppy price action happens. The bulls want to push it up, but when we get near $92, expect the sellers to reappear. Expect the profit taking. Expect the paper shorts to try and defend that level to keep the trend bearish. Price discovery is likely to lead to a test of resistance near the 10-day average at $100 currently. We need to break $92.95 to confirm the crash is over. Until then, we are just consolidating. We cannot talk about silver without talking about its big brother, gold. Silver is the volatile sports car, but gold is the engine. Gold managed to rebound from session lows as traders rushed to buy gold after the strong sell-off. Why did they rush to buy? Because gold is money. When the price dropped, the central banks, the sovereign wealth funds, and the smart money saw a discount. They didn't see a crash. They saw a Black Friday sale. Here are the levels you need to watch for gold. In case gold manages to settle above the resistance at $4,680, $4,700, it will head towards the resistance at $4,880, $4,900. This $4,700 level is critical. If gold reclaims $4,700, it signals that the safe haven trade is back on. It signals that the wash nomination panic is fading. It signals that the market is realizing the Fed is trapped, regardless of who the chairman is. If gold pushes to $4,900, silver will draft behind it. Silver moves faster, but gold sets the direction. Watch $4,700 on gold like a hawk. If that breaks to the upside, silver's test of $92 becomes highly likely. So, what is the game plan for silver in the next 24 to 48 hours? Silver attempts to settle back above the resistance at 78 hours, 79 hours, as the market tries to recover after the brutal sell-off. We need to conquer this $79 level first. That gets us back into the safe zone. A move above the 80.0 level will push silver towards the resistance level at 87.0, 88.0. This is the roadmap. Hold 71.32 as the floor, break 79.64, the range midpoint, reclaim $80 psychological level, target 87.11, 88.0, the next resistance, war with 92.95, the 20-day MA. If we see silver hitting $87 or $88, the sentiment will shift overnight. The bears who are gloating right now will start sweating. The shorts who piled in at the bottom will be underwater. That is how short squeezes start. Now, let's zoom out. Why is this volatility happening? The charts tell us where price is going, but they don't always tell us why. The why is the disconnect. We have a paper market that is leveraged to the hilt, reacting to news headlines about Kevin Warsh and Fed nominations. And we have a physical market that is draining real metal from the vaults. This drop to $71, this bounce off the 50-day, this is the paper market convulsing. It's a liquidity event. When margin calls hit the broader stock market, traders sell what is liquid. They sold paper gold and paper silver to cover their losses elsewhere. But did you sell your physical stack? Did the central banks sell their vaults? No. The physical fundamentals haven't changed. The solar panels still need silver. The EVs still need silver. The strategic stockpiles are still empty. This stabilization at the 50-day moving average proves that underneath the paper manipulation, there is real demand. There is a bid that says, if you drop the price to $70, we will buy it all. The premium on physical coins is likely separating from the spot price again. While the spot chart shows panic, the dealer sites show out of stock. Do not let the volatility shake you out of a long-term thesis. They want your shares. They want your contracts. They want you to panic sell at the bottom so they can buy it back cheap. Listen, markets like this are designed to destroy you emotionally. Friday was a gut punch. Seeing a 37% negative range is traumatizing for a leveraged trader. It wipes out accounts. But if you are an investor, or if you are a smart trader who manages risk, you look at the structure. The 50-day held. The anchored VW upheld. The 71.32 low was rejected. We avoided the bearish inside day. These are constructive signs. But, and I cannot stress this enough, do not get complacent. Expect choppy water. Expect them to test your resolve. They might try to retest $71 again just to see if any weak hands are left. If you are long, your stop loss is your best friend. If you are stacking physical, you are just looking for better entry prices. To wrap this up, the bleeding has stopped. The patient is stable. Silver found support where it had to, at the 50-day moving average and the October VW up. We are seeing buyers step back in above $71. The target is now $80, then $88. Gold is trying to reclaim 4,700s. If it does, the whole complex moves higher. Complex. But the 20-day average at $92.95 looms overhead like a dark cloud. That is the battleground for the rest of the week. I will be watching the New York Open closely. I will be watching the Shanghai premiums. I will be watching the Bitcoin correlation. If you want the truth about these markets, if you want the analysis that the algorithm tries to hide, make sure you are subscribed. I don't sell courses. I don't sell mentorships. I just give you the raw data and the levels that matter. Check the levels I gave you. 71.32 support, 92.95 resistance, $4,700 on gold. Write them down. Trade your plan. Do not let the emotions of a 37% drop dictate your future. The paper game is breaking. The physical reality is inevitable. Stay sharp. Watch the 50-day.